Hey everybody, Preston Brent here with our free edition of our weekly Trader User Group Roundup. This is for the trading week ending November 22nd, 2019. Everybody, I'm Preston Brent. Thanks for tuning in. Well, this week's theme is more money means more candy. I'll explain that in a minute. But all the markets in the U.S. were down just slightly, under 0.5% or so. Really not much. It's just kind of a resting week. And we saw world markets about the same, really. Most of them were down anywhere from 50 basis points to 75 basis points. The FTSE was the lone holdout. Well, actually, there were two. The FTSE, which is the London markets, it was up about 33 basis points. Hang Seng was up just slightly over 1%. But they've been down. They're in an official recession because of all the rioting and marching and protest over there. We've seen weekly sector performance here in the U.S. The best performing sector was healthcare, up just slightly under 1%. The worst performer was the communication sector, coming in at about 2.07% down. And we've seen the current trailing 12-month PE ratio continue to fall. Obviously, as we move forward in time, we're taking on lower earnings expectations. It's about 20.93. But the forward PE ratio, which is to me the one that's a little bit more important, it's at 18.9 roughly. It's still lower than the trailing 12 by about 12%. So the markets are still pricing in some more slowdown. The annual dividend yield is still around 1.87, 1.85. The 10-year interest rates, around 1.77, somewhere in that area. So they're close enough where there's still money that's really pushed into the market. So this coming week, guys, for those of you that are international, is a big holiday week here in the U.S. We have Thanksgiving coming up this Thursday. So we're going to see all markets closed for the day. And then Friday, the markets are going to open a half a day. And they're going to close at 1 p.m. Eastern Standard Time on Friday. And of course, this is going to be immediately followed. I say followed, but they've been having specials and holiday and year-end and Christmas sales and all retailers. But Black Friday is officially this Friday. So this is when the consumer slugfest begins at all the retail stores. Inevitably, we always see the holiday cheer on these commercials and TVs where people are beating each other up and fighting for that special holiday Ram rocket jet for the 5-year-old Johnny back at home. So it's going to be funny to see how that holiday spirit come in this year as well. So far this year, though, all the indexes really are higher all across the board. It's brought in an additional 6.2 trillion in wealth. Okay. So needless to say, most retailers are most optimistic about the consumer spending, which continues to keep the U.S. markets in balance and moving forward, even though we've had, a little bit of a slowdown in the manufacturing space. In fact, the National Retail Federation, NRF, is expecting year-over-year sales increase this holiday season of about 4%. Okay. Now, if we look at the industry stats for this week, because it is one of the slowest trading weeks all year, okay, from Tuesday's close through Friday's close going into the weekend, which is kind of when people start taking off, right? The day before, the full day off, and then they don't show up on Friday. 84% of the time, the S&P has closed higher going into the weekend to the tune of a little bit over 1%, okay? And the trading volume is about 60% less than normal trading volume during a normal week, 60 to 70% less. So it's very low. Now, you would think with lower trading volume, prices daily would swing a pretty good bit. But again, I'm pulling out stats here. On average, the daily price swing in the U.S. market is around 30 basis points up to down, low to highs during the day. So that's fairly low. So, again, now last year in November and December, we had, as you know, almost a bear market, and markets were falling very strong. So, but just on average, going back about a century, a little over, let's call it a little bit more than a half a century, 60, 70 years. That's what we've seen this week. Now, keep in mind, markets have made fresh new highs, and it's also against the backdrop of slowing global growth. But the reason why I said earlier that more money means more candy is that beneath the surface, there's something that, the economists, they don't come up with anything very sexy. They got an acronym called M2 money supply. but you got to search for it and find out what it is. But it's always good to just kind of keep that in check. Think of that like the amount of gasoline that's in your car. Okay. And the M2 money supply, which really is just a measure of all cash, all savings accounts, checking accounts, CDs, money market funds, those kind of things. It just basically those things that consumers can get at fairly quickly, okay, has climbed 31% this year. So that's why there's still a lot of cash on the sidelines with these markets, but that means that this is going to be pumped in, and it should goose the year-end close as consumers are continuing to spend. So we're seeing that, and this does not take into account, by the way, does not take into account the Fed's pumping in over 60 billion per month in money markets buying T-bills. And remember, they don't want you to call it QE, but whatever you want to call it, they're putting more liquidity into the markets. And they're buying T-bills. That's the short end of the curve, the 2-year. Anything less than 10 years is a T-bill. Anything between 10 and 20 is typically a treasury note, and anything over the 20 is called a bond. But they're buying T-bills. So what that did immediately once they started doing that was uninvert the yield curve, okay? Especially the threes over 10, the 90-day versus the 10-year. Because at one point, the 90-day T-bill, which is interest you would collect in 90 days, was actually higher than the interest you would collect in 10 years, which is amazing. But they uninverted that, and that puts a lot more liquidity into the markets, okay? So that has an effect on money flowing into the equity markets, guys. I mean, it just is what it is. So that's why more money means more candy for the market. So you got to be careful, because typically the backside of this is not very good. Now we can all hope for a soft landing, and if the Feds can engineer that, then it'll be a good thing. But that's why you're seeing this theme across most business channels right now, where you got one side of the panel is saying 2020 is going to be ugly. That's where we're going to kick off the bear market, or at least a big downdraft. And the other side of the panel is saying it's going to be a great year. We're going to move up to 3,300 or 3,400. So we're still, and that really, if you think about it, is what makes a market. Okay. And as long as we don't get too optimistic, then we're going to go higher. All right. I mean, we're seeing signs of PMI numbers starting to stabilize a little bit. They're lower, but they're starting to stabilize. We're also seeing the Treasury notes and the bonds further out in the yield curve moving up interest rate wise. So that's a vote on the macro economy, right? And as interest rates move up, the markets are going to begin to price in a rise in bond yields, which, as they turn higher, the price of bonds falls. So, we could be in one of these scenarios like that for the next year or two. So it's going to be really interesting to see how this thing plays itself out. Now, if you look at the screen that I have here right now, you can see that for those of you that have been following me for a while, we caught this beautiful. I mean, this was a buy the dip kind of moment, okay? That was about a 7 or 8% pullback, and we got short right about in this area right here, about the last week in April before the pullback. And then I had that projection there as that's where our high is going to come up to on that buy the dip moment. Now, this is a daily chart, and sure enough, we came right back up into that area here, okay? And then right up at that level right there, we also played this to the downside as well, okay? So that was another good move for us, especially for our members. But again, it was a buy the dip moment, even though we pull back, I would say about 7.5 or 8%. Okay. And then I put this projection up here like this. And now look, after this short little downdraft leading into October, we've had a huge run in the month of October. Huge. And this was my target back then. So we've hit both of our targets, okay? We've been able to play these dips nicely for our members. And we were getting short on the dips, obviously, taking profits and things like that. We've got strategies that we don't really need to predict where the markets are going to go. And they work out nicely for us. And no, it's not just selling short puts, because that can kill you if you're not careful. And eventually it does. You can see here with the MACD, there is no sense of a weakness in this big move in October. This is probably more cash coming into the market. You can see this yellow line here is a value area where the most volume took place, right at about just slightly under 3,000. I said I wanted the 3,000 or the 3,100 to hold for this weekend. Now, in this holiday week, we're going to get low volume, and we're going to start to see just how much the consumer is willing to spend as we go into Black Friday on this coming Friday, which will be um, a half trading day. And then we've got that's followed by Cyber Monday, which is coming with all the online things that are going to be happening. So there's going to be a lot of spending going on. And generally in the trading world, most of the big traders leave the desk and leave the junior guys around, so they're not going to be doing big moves. Some of them may, but I doubt it. We can get a scare and a scare the children moment, but right now, as you can see, a little bit of a consolidation in this big move up from October makes sense to me. In fact, I had told our members I would not be surprised to see it come back. Remember, what was resistance becomes support if you move through it. So this whole colored bar is like a support zone of 30.94 right down to around 30.68, So about 30-point support point down there. Should we break it, around the 30.35, 30.25 area is what I was looking at. You can see the upward vector of both the 50 and the 200 EMA. So everything is still bullish. And as I've told our members, I told our members way back in the summer months of this year that, if we get the three legs of the bar stool line up, we'll be up over 3,100, 3,150. And as you can see here, the all-time highs in the E-minis were 31.32 that were made this past week. Okay. So that's a little bit about what I'm seeing in the S&P 500. NASDAQ is even stronger, right? If we look at the NASDAQ 100 futures, again, we called it really nicely, both the May and the August pullback, the resistance points, and now we're up at this resistance point here. There is no divergences. We've got a high upward vector on both the 50 and the 200 EMA. So any little bit of a pullback here is going to be softening, and I would be more of a buyer than a seller as we go through the end of this year, which is also seasonally a very strong time, okay, for the markets. If we look at the Dow actually made, again, an all-time high this week, 28,128. We've blown through some of these key levels here really nicely. There is no divergences on the Dow either. Now, the one that I'm kind of watching very closely is the Russell futures, okay, which is the RUT, right, Russell 2000. You can see we have not made new 2019 highs, let alone all-time highs. If we go back and look at it on a weekly chart here, you can see the all-time highs in the rut were made back here on September 3rd, right before the Labor Day holiday here in the United States. It went into a bear market. This would be a cyclical bear market rather than a secular, because we're still in a secular bull market from '09, but it did fall about 27% from the peak, 1746, to the trough down here of 1252, right? That's almost 500 Russell points, folks. That's a lot. And now we're coming up here and we're digesting this move here. And you can see we've been in this trading range, as I've told you guys on our weekly updates here, quite some time. I can extend this line out and you can see, just where it runs. And then let's just extend it out over here like that. And you can see that at one point we're going to break either to the upside or to the downside. I believe the break is going to come here and we're going to make a run up here again. I think we'll see that when we get the third leg of the bar stool screwed on tightly, and that would be the phase one deal. And I get it. It's not going to be a big thing. It's not going to be a lot of progress as far as the overall scheme of the China-U.S. trade deal goes. It's not going to be the big picture of the evolution, but just, stop beating yourself up about that. All the markets want to see is that we're making progress. It's like an earnings report where they miss, but they missed less than what was forecast. So a miss is a miss, but the markets don't price it out that way. If you miss, but you miss less than you think, then it's a little bit better than before. So that's just, and the markets do the same thing with everything. So this is where people sometimes just really underestimate just how wacky the markets can be sometimes. Okay. So we're seeing the Russell right here just kind of bumping up against the 1621.90. And for our members tonight and our weekly market watch, I'll go through a couple of really interesting plays to make on this when it breaks out. I believe it'll break out. But if we come back down and work our way back down, then if we break this lower boundary that I had highlighted in here in yellow, we're going to come back down to the 2018 closing price of 1353. I don't see that happening, guys. So if I look over here and I see here on the treasuries, right over here with treasuries, you can see um, some of the things that are really moving here. Now, if we look at the bond market, okay, and let me just put this thing on here on this weekly chart. I'm going to put it on a daily chart just to give you an idea. So when bonds are going down, interest rates are going up. And you can see here, we're still in this downward pattern. I put this regression channel on there, okay? And the width of the regression channel is around 0.85, so it's a little bit wider, which means it's a little bit of a choppier move, but it's still moving down. And I said once we get up to this level up here, I'd be more interested in selling the bonds instead of buying them. In fact, a lot of macro funds are playing bonds to the downside for 2020, which basically means interest rates are going to go higher. Okay, so that's a little bit about where I'm seeing the bond market. And then again, if we look at the interest rates, we look at the 10-year. You can see here with the 10-year, as bonds go lower, interest rates going higher. So we're down towards the lower boundary of the regression channel, which suggests interest rates are going to bottom and start to move higher again. Okay. And if we have a strong finish into the year, that's exactly what's going to happen. All right. It's just going to happen. If we look at currencies here with the dollar, dollar had a strong finish on Friday. Let me just get this thing off of here so it doesn't get in my way. So you look at the regression channel here on the US dollar, it's fairly wide, right? I mean, really wide. The regression channel is at 0.51. The lower the number, the wider the channel. But it's still up moves. I mean, we're making higher lows, higher highs. And, as I said, when we get in this lower part of the channel, the odds would favor the dollar moving up. When we get in the upper part of the channel, the odds would favor the dollar moving lower. And for our members, I've been calling out some trades in the currency market. And I like currencies because they tend to trend. Okay. So the dollar still, in the near term, looks like it's going to move higher. And if we look at the euro, again, if we look at the trend and the regression channel, it's almost the same as the dollar, and it shouldn't be surprising because it's really the dollar index, and the euro is about 58% of the dollar index. So generally, wherever the euro goes, the dollar goes in the opposite direction. So you can trade in euro futures, euro dollars. You could trade FXY, FXE, which is the euro ETF. But you can see here that we're getting down towards the bottom down in this area here. So I would be, rather than chasing it down here, I'm going to stand back just a little bit and just kind of see. And if it starts to turn up and we get a signal, it'd be more interesting for a long. Now look at the British pound. If you look at this regression channel here, we've been in this beautiful regression channel to the downside almost all year. This really kicked off in March. And this has just been a winner, for our members all year long. And then once we broke it to broke the downside move, it showed some stabilization. Now all we're in right now is a consolidation pattern. The initial pattern looked kind of like a bull flag. Okay, so like if I were to draw the flag pole or the tent pole and then draw that right there, right? That was kind of what the initial look was right there like that. So it looked like a bull flag. And we did break to the upside, but we couldn't get the escape velocity. So all we're really doing is digesting the current moves. And then I promise you we will break up or down. We're coming up on a vote on December 12th. And we're going to see if um, um, Bulldog Johnson gets enough votes in Parliament. He's going to hopefully get more people in that favor his approach, which means he'll have more voting power in the Parliament to do what he wants. I suspect if that happens, we'll get a move higher. Okay. If not, then we'll get a move lower. But we're gonna play this and just kind of see how it works. But playing it before that vote is just flip a coin. It's not something I would recommend that you do. Okay. If we come down and we look at gold, gold is still in this downward trajectory, all right? And it's just steadfast. It's just been moving down really since September, okay? It's just been moving down all going back for quite some time. We're seeing the 50 moving down, the 200 is moving up. They'll probably meet somewhere out here in December, January timeframe if it keeps this trend up. I would not be surprised if it doesn't. It's going to take a lot of energy to kick it up. We had our trigger to go long back here in the summer on gold. Our choice and trade was silver. Silver is doing the same thing now. It attempted to break the downward regression channel, right? That down channel. Let me just put it back on a weekly and get that thing off again. So it attempted to break it, but it couldn't get the escape velocity I wanted in the follow through, and we're right back down into this channel again. I think it's going to go a little bit lower and then settle in for a bit, and then we're just going to kind of see how we're moving forward. Now, if they get that phase one China deal done, then that's going to be the third leg of the stool, and we're going to come back up, make new all-time highs in equities. You'll see silver and gold come back down a little bit. Okay. Oil, if we look at the oil markets, it's trying to get a little bit higher here. Okay. OPEC is meeting on December 5th through the 7th in Vienna. They're on record as saying they want to cut production even more because the supply is more than demand. And that is giving us this little bit of a move higher from the lows in early October. Okay, and remember, oil is also moving. If you remember October, we moved up over 6.5 or 7% in the equity markets. And that also provided a lift to oil because of the idea that more energy is going to be needed as the equity markets get stronger, that kind of thing. So we're still, but the 50 is still below the 200 EMA. We're sitting kind of at a level I've been calling all year, which is around $55. If we get up a little bit higher, I would be more interested in shorting it. We had a beautiful short opportunity back over here that I posted in our chat room, and some of our members took it. And it was a great trade where we had that cruise missile come and hit the Iranian refineries, put them out of business for a couple of weeks, but they came back and put it back online again. And you can see oil gapped up well further than it should have. And that was just a short waiting to be taken, right? And that's what we did. So I love these imbalances in the commodity markets when this happens. If we look at nat gas, well, nat gas, I think it could have a little bit of a run higher. Okay. I don't see any divergences here. I know a lot of macro players in the energy market are projecting nat gas will come lower. But you notice the 50 and the 200, the red line, the yellow line are right on top of each other. So we got a lot of support just beneath it. But I don't see any divergences here. So I would be more apt to go long than short. But right now it's a no signal for me. If it rolls back over, then I would be interested in doing that. Okay, so that's how I would play that market. Now we have other markets in ag, meats, and softs. Some other things that we got going on with members. I will be showing you over the weekend and tonight's, I guess, weekly market watch. If you're not a member of our group, I highly encourage you to come in and join us. We're kicking it this year, and I think next year should be even more interesting. There'll be some surprises next year in the markets for sure. So we're going to see a winner emerge, whether it's a bull winner or a bear winner. So we'll see how it all shapes out. Otherwise, have a really great week, everybody. For everybody in the U.S. markets, enjoy time with family and friends. Don't eat too much money this week as we go into a big holiday week. Members, I'll see you tonight in our weekly market watch. Take care, everybody. Ciao.